Welcome to the podcast. This is Monday the 28th of January. Quick look at the week ahead as to what we can look forward to in the scheduled announcements. Starting with today, we have continued numbers out from the US. Caterpillar we will be looking at quite closely. Caterpillar is a global player and one that should benefit from increased activity on global GDP. They've certainly been expanding in the emerging markets. We also have numbers out from tech company Yahoo. In fairness, tech companies have generally been the disappointing feature of the reporting season, say for Google. We'll talk about Apple later in the presentation. Continuing tomorrow with Pfizer, Ford and Amazon.com. We'll also hear the meeting for the FOMC. No changes there expected on rates, indeed, or any sort of further QE programs. The announcement last year of targeting the unemployment rate at 6.5%, and the stimulus that's provided, unlimited stimulus provided until that point is reached, should set FOMC's decisions going forward into 2013 in stone. So little in the way of surprise expected there. Wednesday, Boeing's numbers will be interesting relating to the Dreamliner activity. Dreamliner has clearly had some technology problems, which has grounded many flights around the world, and using those planes, Japan Airlines have stopped all flights at the moment. One would have thought that may have hit Boeing's shares harder than it has. The shares have held quite steadily through that period, so some update expected on Wednesday there. On Thursday, we start to see the first of the UK earnings coming through, Shell and AstraZeneca being two of the heavyweights coming through on Thursday of this week, along with, of course, MasterCard and Colgate. Now, I've put down mention here of the short selling ban on Spanish stocks. That is due to expire on Thursday, and if indeed they allow the ban to expire and for the resumption of short selling on Spanish stocks, it means that all European stocks now will be available to short sell, and that means many of the futures contracts around short selling can start to begin as well. Of course, equity markets have rebounded very strongly since the short selling ban was put into place. It's whether the regulator in Spain has the confidence to lift that ban and allow some of these markets now to return to their normal state with the ability for funds to be able to go long or short of these markets. So as I say, that will be interesting on Thursday. On Friday, the US, it's the big non-farm payroll data and US Q4 advanced GDP. Now, on non-farm payrolls, the number there is expected to come in around 150,000. That's a similar number to December. And on the Q4 advanced GDP, the impact of Sandy, Hurricane Sandy, on the US economy will mean that US economy has slowed in its growth. Also, the concerns over the fiscal cliff will have dented confidence. So the number is expected to come back from a Q on Q 3% last quoted. This quarter, I reckon we're looking more like 1 to 1.2% in the US. Now, just taking a look at some of the charts of interest. The sterling chart versus the euro versus the dollar continues to remain of interest to me. We are seeing some much more volatility coming into currency markets across the globe. We've been talking about this for a few weeks. There is a real trend for easier sterling at the moment. This follows the Q4 GDP number that was quoted last week. It came in at 0.3% negative against 0.1% forecast. That was obviously a much weaker number. Some say driven by Brent crude. There was a shutdown in the pipeline which will have impacted, but as always, we can always make excuses for these numbers. It is a poor number. We are looking this week at some PMI data. They call it the Purchasing Managers data for manufacturing in the UK. And these are forward indicators, sentiment indicators, but they all plug into economists' forecasts for what the first quarter is looking like. And of course, if we get a continuation of the negative quarter in 2013, then we will officially enter back into what we now know as a triple dip recession. So these numbers are all important in testing how sterling is going to trade. It is very weak against, as I say, the dollar, even weaker against the euro. The euro has been very strong. There's been a 5% depreciation of the pound against the euro in 2013 alone. And what this does mean is that should be good for UK exporters, and the Europe land is is effectively our biggest export partner. So that is good news. I do fear slightly that the strength of the euro at the moment is making or resuming battle with particularly some of the less competitive European countries, such as the southern hemisphere, southern European countries. There's talk, I saw a piece of research that they need against the dollar a figure of say 115 to 120. Well, we're actually at 135, meaning that they're already becoming very uncompetitive with these high rates of euros. So I expect the conversation that as we approach the G20 conference is going to increasingly turn to the concern now that the euro is strengthening a little bit too fast for its recovery. So we'll keep an eye on that. Now, turning to some stocks, I want to just mention SAP. SAP is a company which we've produced some research on. We've upgraded our research to buy. SAP sits in the ERP space. This helps large organisations manage their data, and SAP feel that they have got a very much a new technology, a market leading edge technology, which is to be launched over the course of 2013. And so we've put this stock out as a buy. As always, the research is available. Just call your broker if you want a copy of the SAP buy note. Moving on to two more stocks. I'm looking at Vodafone. Vodafone was an underperformer through 2012. Indeed, it really had sort of ended the year in fairly poor fashion, down at the 155, 160 level, where the shares were yielding around 7%, and concerns over particularly their European business, pressures on call revenues, all of the issues that drove that stock down. But this week we have had some encouraging news out from people who follow Vodafone. In particular, I saw a letter from US hedge fund manager David Einhorn, who was looking at Vodafone through the eyes of Verizon, where they have a big stake, and arguing that that stake was in effect in for free. So he was highlighting Vodafone from a valuation point of view, and that seems to have done the trick. The shares have really turned quite sharply from 155 up to 171, and certainly a trend is underway there, a reversal of the trend from 2012. So keep an eye on Vodafone. And finally, can't finish without at least some comment on Apple. Apple shares, the results last week disappointed. Guidance was lower than anticipated. It was really what the bears required for a further fall in Apple share price. We have got an updated note on Apple. We're highlighting the value. We will continue to highlight the value, even though this share is obviously under quite a sharp attack from the bears at the moment, dragging the stock price down as far as it has. But we're highlighting the fact that we're now down to about 7 times earnings. There's clearly a question mark over earnings going forward, but we feel at the moment that the sentiment has become too negative surrounding Apple at the moment, and so we're putting a note out. Again, that note is available through your broker.